part we have discussed investment in Sukanya Samriddhi account. In this part we will discuss investment in ULIPS or unit-linked insurance plan. ULIP or unit-linked insurance plan has a mix of insurance along with investment. From a ULIP, the goal is to provide wealth creation along with life cover. A part of the premium paid is utilized to provide insurance cover to the policy holder, while the remaining portion is invested in various equity and debt schemes. The money collected by the insurance provider is utilized to form a pool of fund that is used to invest in various markets instruments, debt and equity, in varying proportions, just the way it is done for mutual funds. Policy holders have the option of selecting the type of funds, debt or equity, or a mix of both based on their investment need and appetite. Features of ULIP. ULIP policy holders can make use of features such as top-up facilities, switching between various funds during the tenure of the policy, reduce or increase the level of protection, options to surrender, additional riders to enhance coverage and returns, as well as tax benefits. Types. There are a variety of ULIP plans to choose from based on the investment objectives of the investor, his risk appetite, as well as the investment horizon. Some ULIPs play it safe by allocating a larger portion of the invested capital in debt instruments, while others purely invest in equity. Again, all this is totally based on the type of ULIP chosen for investment and the investor preference and risk appetite. Risks. Since ULIP returns are directly linked to market performance and the investment risk in investment portfolio is borne entirely by the policy holder, one needs to thoroughly understand the risks involved and one's own risk absorption capacity before deciding to invest in ULIPs. Providers. There are several public and private sector insurance providers that either operate solo or have partnered with foreign insurance companies to sell unit-linked insurance plans in India. The public insurance providers include LIC of India, SBI Life and Canara, while some of the private insurance providers include ICICI Prudential, HDFC Life, Bajaj Allianz, Aviva Life Insurance and Kotak Mahindra Life. Taxability deduction is available on ULIPs under Section 80C, provided the sum assured is at least 10 times the annual premium. This is within the overall limit of Rs 1,50,000 of Section 80C. Of course you can invest a higher amount, but the deduction will be limited to Rs 1,50,000. Tax benefit on maturity. Partial withdrawals are allowed after 5 years. There is no tax on the withdrawals and maturity for ULIPs provided the sum assured is at least 10 times the annual premium. Advantages of investment in unit-linked insurance plan. Liquidity. Unit-linked plans have limited liquidity. One needs to stay invested for a minimum period of time as specified in the policy before redeeming the units. Flexibility. Unit-linked plans give you flexibility to invest as per your risk profile, financial commitments and convenience. Market-linked returns. Unit-linked plans give you an opportunity to earn market-linked returns as part of the premiums are invested in market-linked funds which invest in different market instruments including debt instruments and equity in varying proportions. Life protection, investment and savings. Unit-linked plans offer the twin benefits of life insurance and savings at market-linked returns. Thus, you have the opportunity to invest your money to earn higher returns, while taking care of your protection needs. Investing in unit-linked plans helps to inculcate a regular habit of saving and investing, which is important for building wealth over the long term. All unit-linked plans offer tax benefits under Section 80C up to a maximum of Rs 1,50,000. Disadvantages of investment in unit-linked insurance plan. First disadvantage of ULIP plan is that the insurance plan and an investment plan both are merged into single ULIP plan. One should keep insurance and investments away from each other. Take a term insurance and invest in mutual funds. You lose a lot of amount as entry load in ULIPs which take a minimum of 5 years to recover. Mutual funds are completely transparent whereas ULIPs are not. Disadvantages. If you want to really benefit something out of ULIPs, then you have to invest in it for 10 to 15 years. The insurance part of the ULIP costs too much. ULIP is quite a long-term instrument as their lock-in period is 3 to 15 years. Premium allocation charge, mortality charge, fund management charge and many more hidden costs are very high. Complexity. ULIP's plans are more complex as compared to mutual funds and other investment plans. Low returns. Mutual funds and investment plans have more returns as compared to ULIPs during a period of time. Hope the presentation is useful for you. If you have any query, please write us. Our first priority is to respond to our subscriber queries. Your feedback is important for us. Write us at tldcdeli@gmail.com. Call us at 0999988235. In the next part of How to Save Tax, we will discuss tax saving expenditure principal payment on home loan. Never miss a chance to view new videos. Subscribe our channel and like our videos. Currently the subscription is free. Now once again for those viewers who have not viewed the earlier parts of How to Save Tax, let's shortly take a quick view of summary of some of important investment for tax saving. Maximum of Rs 1,50,000 deduction for income tax is available by combining investment in these three sections. Section 80C, Section 80CCC for pension products. Section 80CCD. 1. New pension scheme. ADCCD 1B. Additional deduction for amount contributed to NPS of up to Rs 50,000. ADCCD 2. Employer's contribution under Section ADCCD 2 towards NPS is outside the monetary ceiling of Rs 1,50,000 deduction. Following options are available for deduction under Section 80C, 80CCC, ADCCD 1. The maximum deduction combining all these investments for expenditure is Rs 1,50,000. Investment option, debt. Provident funds, EPF/VPF. Public Provident Funds, PPF. National Savings Certificates, NSC. Senior Citizen Savings Scheme, SCSS. Tax Saving Fixed Deposit, for 5 years. Investment option, other. Life Insurance Premium. Pension Plan from Insurance Company. New Pension Scheme, NPS. Tax Saving Mutual Fund, ELSS. Sukanya Samriddhi Account. ULIPS or Unit-Linked Insurance Plan. Other investments. Tax Saving Expenditure. Principal payment on home loan. Stamp duty and registration cost of the house. Tuition fee for 2 children.